Everyone, we're going to get started. I know we're running a couple minutes late, and you are going to be stuck with me for like the next hour. So I hope you like poetry, because we're going to be doing a poetry reading. I'm obviously kidding, Elaine. My name's Steve Palley. I chair the digital asset practice, the cryptocurrency practice at Brown Rudnick, and I am a litigator. And I focus most of my practice these days on digital asset disputes. Am I getting some feedback? I think, okay. Mostly on digital asset disputes. Before that, I've been practicing for almost 30 years. I sued insurance companies for corporate policyholders. There's actually a connection between my insurance work and crypto, and I would say insurance and litigation funding. I will tell you before I begin my comments, though, I've been focused on crypto for about 10 years. And the fact that I am standing in a room talking to, I was trying to estimate before, people with access to or control of billions of dollars in capital talking about crypto is kind of amazing to me. I started doing this 10 years ago, and when I did, I wrote a column probably 7 years ago for the Block Crypto, a trade publication called Crypto Case Law Minute, where I would talk about new crypto opinions. And it was sometimes hard to find cases. I had 3 show up in my inbox this morning, one of which I'm actually going to tell you about during this presentation. It's happening very quickly. The market is definitely maturing, and I think there are definitely opportunities for people in this room. So thank you very much, Elena, for asking me to speak. I'm also looking forward to the panel in 14 minutes or so, and I'm going to put my timer on here so that I don't go over. I want to begin, probably most of you don't follow me on LinkedIn, and you probably shouldn't. It's not that interesting. Mostly what I post about these days, a few people in this room who do follow me know that I really love poetry. So anytime I have an opportunity to share poetry, even if it's difficult to make the connection, I'm going to begin with a poem. So I actually want to begin with a snippet of a poem, not the entire one. I was told I shouldn't do that. By one of my favorite poets, the great American poet, Jack Gilbert. I promise you I'm going to connect this to what I'm going to talk about. Jack Gilbert writes in one of my favorite poems, "We must risk delight. We can do without pleasure, but not delight, not enjoyment. We must have the stubbornness to accept our gladness in the ruthless furnace of this world." Isn't that great? I mean, even if you can't see the connection to litigation funding or to crypto, I think it's a wonderful sentiment, and I hope it's something that you all take to heart. One of the reasons I read poetry is for that sort of inspiration. But why start with this at a conference about capital allocation and lawsuits, and in a presentation about crypto digital asset claims, opportunities? And I would say this, because litigation, especially in digital assets, lives in that furnace. It's a place, like a lot of financial litigation, it's a place of collapse. It's a place of ruin. It's a place of fire sales and fraud. I see all of it, just like I've seen it for nearly 3 decades as a litigator. And that's also what's interesting, too, is this seems like a really esoteric, experimental thing, but as it's written in Ecclesiastes, there's nothing new under the sun, right? Sometimes just a question of recognizing that what you're looking at is the sun, or seeing a pattern. And so part of what I would say to people who are investing in these things, when you see the opportunity, the financial opportunity, what you look for is the recognizable pattern. How do you determine damages, which is something I'll talk about in these cases? How do you underwrite these claims? And I think we're starting to see, out of the ruin and chaos of some of the early crypto litigation and some of the emerging case law, we're starting to see that. We're starting to see ways to apply underwriting rigor to digital asset claims. So in addition to being a place of fire sales and fraud, it's a place where some emerging clarity arises, where structure is rebuilt and where stubbornness pays. This is where we find ourselves today. Yes, amidst the wreckage, which is where litigation has always been and always will be, nothing new under the sun. but it's a place where that wreckage can be monetized, clarified, where people's lives can be changed, and where victims can be made whole, and where you can make a whole bunch of money if you're an investor, if you play things smart. Earlier waves of crypto litigation, like when I started this, so I spent many years suing insurance companies for corporate policyholders. I did a lot more of that. I discovered crypto while building software, and my practice, like sometimes young lawyers come to me and say, it's such a cool practice, Steve. How did you end up as a crypto lawyer? And I say, well, in 1998, when I began practicing, I created a business plan about this thing that didn't exist yet, and I followed. That's not true. I kind of stumbled into it accidentally, and clients ended up following me because I understood crypto. I understand things like liquid staking. I understand something about cryptography. I understood how it worked, but I also fundamentally understand precedent, court, how to stand up and talk, how to draft a pleading. So earlier cases were somewhat chaotic. They were often bold, clumsy, procedurally fragile. You had regulators in the United States and elsewhere jumping in, so in the US, the SEC, the CFTC, and often when a regulator like the CFC, the SEC would jump in to a fraud case, they would seize the money first. So the ability of private plaintiffs to recover might be limited. You might be stuck with a fair fund. Litigation over DAOs and implied general partnerships with still unclear case law were also maybe less appealing recovery targets. So for funders, it might have looked slightly radioactive, still experimental. Valuation volatility, which we'll talk about, jurisdictional uncertainty, enforcement nightmares. So a lot of rational capital said, we're going to wait. So, I mean, it's not true with everyone, but I think that's been the standpoint of many. We're going to wait. But there's a shift. Bankruptcy judges in the United States are issuing rulings that establish priorities and valuation methodologies. Courts and regulators have clarified in the United States when a token is a security, an investment contract, a security, a derivative. We've gotten some clarifying law in the United States on things like stable coins. Now, this is actually interesting from a where's the puck headed. When you have institutional capital sitting behind stable coins, suddenly you have real money, real targets, and if you take certain centralized stablecoin issuers who actually have money in the bank, I'm not going to name any in particular, but I think anyone who follows the space knows who I'm talking about. You can actually get freezing orders. We did this recently. We worked on something like this recently in a case where we went to a bankruptcy court and asked for a freezing order with respect to 8 figures of stablecoins. So with institutionalization, you have a class action bar that may see opportunities for recovery where you know the money is there if you collect a judgment, which isn't necessarily true if you sue a decentralized autonomous organization. I've been involved in some of those cases, and the trend there is to go after the VCs, to go after A16Z, for example, or Paradigm, but to go after the money behind these things. Whether or not that will work remains to be seen. But I would say what I've seen happen is I still know, I think, most of the leading practitioners in the cryptocurrency bar. I was at a conference on Monday at Fordham University, and it's kind of like Old Home Week. We all know each other, but that bar is expanding. We're seeing many, many people come into the space. So it was once considered an exotic frontier of litigation. I think is fast becoming another familiar lane of risk and reward. And as we achieve regulatory normalization, I think we will see more of that. If you have banks putting billions of dollars behind stablecoins, you're going to have problems. And you're going to see class action lawyers and governments who go after those problems. So there will be opportunities there. I would say if I was going to categorize claims, sort of the current claim landscape, there are a couple buckets. First, you've got bankruptcies and insolvencies. We do a fair amount of creditors committee work. I've been involved in some of those as the litigator, but you're talking about billions of dollars at issue. The striking thing is definitely scale and recoveries that dwarf anything seen in mid-market insolvencies. And unlike traditional smaller corporate bankruptcies, crypto estates often come with large asset pools, as we know, for example, in FTX. And that litigation, the litigation trust litigation is going to go for years. One of the challenges there, of course, is valuation, digital assets that may fluctuate in value, but that remain real, liquid, and accessible once untangled. Second, we're going to continue to see, and we still see, securities and regulatory claims, issuers facing suits over fraud, misrepresentation, damages models tied to token economics, which I'm going to dig into a little bit more detail in a bit. We're seeing, and I've hired experts who are sort of traditional securities law damages experts to provide calculations of damages, and that can be somewhat challenging when you're not dealing with traditional sort of rational market, right? If you're not dealing with something that's traded on an exchange, how do you figure out what the value of a token is? And also, again, getting back to institutional money coming in, most crypto, when I asked my crypto clients if they have D&O insurance, remember it was an insurance lawyer, they usually laugh. But I know that D&O markets are coming in. I also know that you can now go to Lloyd's. You can now go to Lloyd's markets and you can get cover for things like mining equipment, for crypto you can get crime policies for crypto in cold storage or in transit. You'll also see, and this is where I spend a fair amount of my time, commercial and contractual disputes, battles over custody arrangements, lost keys, staking agreements, busted software, advisor agreements, broken deals, board disputes. I'm working on cases that involve all of these things. I just saw a new lawsuit someone forwarded me this morning, and it involves a client, allegedly a drafting error in a warrant whereby somebody would be, according to the plaintiff, only entitled to $100,000 worth of crypto. And on the other side, they filed a declaratory judgment action. They basically jumped the other side and went to court first and asked for a declaration that they're not entitled to pay. The other side is asking for $270 million. What's interesting here to me is that it's a drafting problem. Fundamentally and functionally, what we're talking about is Scrivener's error in a contract. It just happens to involve crypto. If it gets past a 12b6 motion, a motion to dismiss, we'll be looking at, they'll be looking certainly at damages issues. How do you calculate the value of those tokens? How do you figure out the value of something that may or may not be as liquid as, say, AT&T stock? The fourth bucket, and I don't know if this is overlooked to people in the room, are DOJ in the United States seizure and forfeiture cases. Anybody see the news about the $270 million pig butchering case in the U.S.? Basically, DOJ seized $270 million in assets from crypto exchanges with the crypto exchanges' help in pig butchering cases. I think there may be 300 victims. I know a lawyer who represents a bunch of them. They filed a $70 or $80 million petition, I think it's a remission petition, in federal court in D.C. A week ago for recovery there. Now, the great thing about that case, from my standpoint, in addition to the fact that he's doing God's work and helping people recover, is that the money's there, right? If you win, the money is sitting in a wallet. These are great. I know funders tend to like sovereign claims against sovereigns because they're solvent and they have money. I know collection can sometimes take a while depending on who the sovereign is, but it's similar. A claim involving money seized by DOJ, if the merits are good and you can run the tracing analysis correctly, you know you will get paid in the end. It's also a little bit of a PR and political game. Damages and valuation challenges, I think, are something that we're getting to ground on some of this. I have a case right now where that's basically what the entire case is about. What is something worth? This is one of the most consequential, still somewhat unresolved issue. Under something called the New York rule, in a conversion case, you look at when assets are stolen, you look at the date of the theft, and you use basically a mid-range value for a reasonable period of time thereafter of 3 months. Now the question is, I can create a token on pump.fund right now called the poetry token, or the Palley token, and using my clever knowledge of liquidity, I can make it look like it's worth $1 billion. Is anybody familiar with Fartcoin? No? It's a real token. I'm not just saying it to get a rise or get a laugh. I think at its height it was worth $10 billion. But that's not a rational market, right? So, but if you claimed that you were promised $2 billion of Fartcoin on a particular day at a particular time, you can go to coinmarketcap.com or coingecko.com and you can show a judge a printout from a website that assigns that value to it. But is the value really the value? If there's only $200 million in liquidity, you know that the sale pressure, if you market dumped it, would mean that it was a lot less. So that's one of the things to think about when valuing these claims is you have to look at available liquidity, lockup provisions, and so forth. So you would apply, but there's a model for that, and that is the model of a damages model in traditional securities cases where you're dealing with something where you're not dealing with an efficient market, where you're not dealing with a publicly listed coin. Oh, what do I have, 4 minutes left? Something like that? I don't know. But here's a key point for people who are thinking about underwriting digital asset claims. We're not completely guessing anymore. 10 years ago, there wasn't a ton of case law. We didn't have a lot of experience. I would say now there are real commercial claims against real solvent parties. The issues that need to be sorted out and sussed out in underwriting are there and identifiable. I think definitely institutional, I think we will see more institutionalization, hedge funds, insurers, and private credit funds, both deploying into digital asset investments and also thinking about this from a claim standpoint. The risk profile is definitely starting to look familiar, not alien. Let me see if I can close up so that we can get to our panel. One last thing I would talk about too, and this might seem a little bit pie in the sky, but there's also a world in which the way that digital assets are used and deployed can be applied to litigation funding and financing. Imagine creating something like litigation funding tokens, providing access to, having easier access to capital to go into funds, to fund these things, allowing these things to be tradable. I'm aware of some people doing this as well. So Jack Gilbert wrote of delight in a furnace. Digital asset litigation is not necessarily delightful like any other litigation, but there are definitely opportunities there. I'm happy to take any questions if people have them for 2 minutes or so. Yes, in the back. I can't hear you, which means I'm going to recite another poem. Can you say that again? Oh, duration on the cases. That's a great question. So, what is the thing that lawyers love to say? Come on. Yes. It depends. If you're in the Eastern District of Virginia on the rocket docket in federal court, time to trial is, I don't know, it can be 6 months. Time for an appeal in the Fourth Circuit, maybe a year and a half. If you are in state court in Nevada and Clark County, it could be 5 years. So there's high variability. That's actually, but the great thing about that, though, is that is discernible, knowable data. You can find that out if you want to know how long a case is going to take. But it's an important issue to make a decision about in picking a case. I think it's an important decision for plaintiffs' lawyers to look at as well. Where am I going to file? Anyone else? Yes?
You mentioned tracing. How does tracing work with something like a blockchain where the identity of who owns a particular coin is meant to be unknown?
That's a good question. So you can obviously trace things on a blockchain because it's an open ledger, right? You can see where one thing goes to the next. Here's the thing about crypto, though. You can't pay your mortgage with it, and in most places you can't pay taxes with it. So in order to get it off-chain and get it into fiat, you need to go to an exchange. And in order to use a reputable exchange, you need to provide KYC information. And when you take money from the exchange and wire it to a bank, the exchange knows where you are. So most of the time, to find out who someone is, you can often go to exchange. You can also file John Doe or Jane Doe lawsuits, and use basically what you do is you file a lawsuit against a John Doe defendant. You then use the lawsuit to issue a subpoena to exchanges and ask for the KYC information. And then sometimes you find out who the people are. Sometimes you find out that they are maybe people in the Philippines. I'm not picking out the Philippines, but this came up in the pig butchering cases, and you might be out of luck. But I will say that DOJ pig butchering case did involve seizing assets that were stolen by people who were overseas. So it's certainly not an impossibility. Anyone else? One more question? All right, I told you were stuck with me for an hour, so now we have a panel. You guys want to introduce yourselves real quick, like 15 seconds. Rosie, why don't we start with you?
I'm Rosie Ioannou. I'm a managing director at Fortress Investment Group in their legal assets team. Is that 15 seconds? Do you want a bit more?
That was 16. No, it was good.
Hi, Nichola Marshall, partner at Leigh law firm. Nice to see in the Observer yesterday, The Economist, we were described as the only opposition party, or the real opposition party. That's us.
Justin Brass, I'm co-founder of JBSL Legal Finance. We are an investor in the space and also syndicate deals with other investors.
Marc, I'm a partner with Geradin Partners. I'm a competition lawyer and a collective action lawyer.
So the title of our panel is Portfolio Diversification and Law Firm Funding Strategies, Risks and Returns. And as I said, I like to begin with a poem. So how am I possibly going to find a poem that fits this title? But I happen to be reading Archibald MacLeish, wonderful poet. And in one of his poems, Ars Poetica, he closes by saying, tell me if this is a stretch, guys, a poem should not mean, but be. And so the way I would connect that to our subject here today is that litigation finance, like poetry, is not judged by what it promises, but by what it is, the actual recoveries, the outcomes in the record. I think that ties together, sort of. So Rosie, at Fortress, when you are allocating capital, how do you balance concentration? How do you decide whether you're going to balance concentration in a few big ticket cases versus spending across dozens of smaller ones? What's the thought process?
Yeah, at Fortress we're quite lucky. We're a global organisation, so we're deploying capital in the US, in Europe, in Australia, and across APAC and elsewhere. And so the diversification question for us is a broader one to just if we're looking at smaller cases or larger cases. It's actually in all of the different verticals of legal assets investment. So it's looking at law firm investment, corporate portfolios, buying awards, judgment monetization, and then you get to the single case investment threshold. So looking at the size of the case, which jurisdiction it's in, and then into the granular detail, looking at the underlying liability of that case. Is it an antitrust claim? Is it a securities claim? What's the precedent of that claim in that jurisdiction? What's the procedure that you're looking at? So I think diversification is important, but it also sits across a number of different horizontal and vertical considerations for us.
Marc, talk us through this from a law firm perspective. What does diversification mean in practice? Is it practice area mix, subject matter mix, jurisdictional spread, claim type? How do you think about it?
Well, I think that, we specialize essentially in competition claims. So we do focus on potential both follow-on and standalone claims that we can bring. When there is a potential action, what we do first normally is examine what jurisdiction would be the optimal jurisdiction for that specific claim. That's the first. The second, and maybe I can develop about that. What does it mean to have an optimal jurisdiction? That's a jurisdiction where the law will be most favorable to our clients. We have a firm with offices throughout Europe, and therefore we bring claims for French clients in other jurisdictions such as the Netherlands or in London, depending on where it will be the most attractive for that client. Then we, of course, look at the costs for the claim, and that's very much a question for the litigation funders. Some funders are more willing to invest in the Netherlands than in France, for instance, though things are changing and evolving very rapidly. So we have a grid of criteria that we take into consideration when we decide to go for a claim, and normally we never bring a claim to a funder before we actually convinced that would be a successful claim in the jurisdiction where we plan to bring it.
You said things were evolving and changing rapidly. What do you mean?
Well, I think then when I started doing collective actions 5 years ago, there were very few funders willing to invest in France, for instance. It was much easier to get funding in London or in the Netherlands. And I think things have changed dramatically. A lot of funders are very interested in France for a number of reasons. For instance, in the past month, we got very friendly judgments in 3 areas: in trucks, against a pharma company, and all these are show that we can get high damages also in France. The law also is evolving in the right direction. It's much more friendly to victims than a few years back. So there are a number of reasons why France has become a very attractive place for a number of funders.
Is there an analogy between litigation funding and private equity portfolio theory, or are those two things completely separate? Maybe Justin, you want to talk about that?
Yeah, I think now the litigation funding space has evolved tremendously, especially I think over the past 6 or 7 years, and now, and I think Hugo or Brian may have alluded to this on an earlier panel. People are really taking a look at their portfolio and taking a look at the pie chart, and I think now there's more active management across portfolios as well. And so you want to make sure you're not being overly concentrated in a lot of early stage cases that have the tendency to extend duration. But this also goes for law firms as well, right, who are taking things that on some type of risk. You don't necessarily want to have a book that's entirely international arbitration claims that may take 7 to 10 years to fully run the course. You want to make sure from a law firm as well, you have cases that are turning over and you have a mix of case type, but also a mix of duration. And I think that's one of the things we look closely at in our own portfolio, but then in the portfolio construction of putting together a deal on a subset of cases.
Nichola, I don't know if there's anything you want to add to that about sort of law firm analysis, diversification, portfolio diversification, before we move on to the next topic?
Happy to move on?
Please.
Sorry, I was happy to move on. Do you want me to cover?
Yes.
Well, it's for us, it's quite a new thing, funding. It's probably when you sort of look historically at law firm funding and litigation funding. So for Leigh, for many years, we were established in 1987, so for many years we have self-funded, and that's included bringing large group party actions. Probably funding for us has been maybe the last sort of 7 or 8 years. We have a real mix as a business of turnover work, so work that brings in our regular income, and then the bigger group cases that are obviously more risky and for which we require funding. I had a look across the book the other day, and we have at the moment around 40 group claims, of which around 20 are funded. And that mix of the funded cases primarily has been across a large group of different funders.
I think it's interesting, Nicola's comment there, which underlines one of the things that you have to think about as a funder of these cases, be it on a single case or a portfolio basis, where Nichola said the larger, more risky cases we're taking out to funders. And I think that is something that sits far more within law firm control when they're looking both at single case funding, but also the cases for which they may be looking for deployment of portfolio funding, and something that as funders needs to be a consideration when you look holistically at the book of cases that law firms may be bringing to the market.
Say more about that. Are you saying that's something you need to look at or that law firms need to look at?
Well, it's up to the law firms which they take to the market, but it goes directly to Justin's point, which is you're looking for portfolio diversification. You're looking for cases that have a blend of duration, a blend of budget, a blend of damages perhaps, and a blend of subject matter. But if the law firms are only coming to you with one or two or three of the lumpiest cases, the longest duration, the biggest risk cases, I think that's something that as funders we ought to be cognizant of.
It reminds me, I started practicing in Missouri. Anybody from St. Louis here? All right. Go Cards. I'm reminded of my early practice. I was a defense lawyer. The successful plaintiffs' lawyers, the way they tended to start was they would have volume workers' compensation cases. You knew you were going to get paid on a certain rhythm, right? And then what you would do is you would build that up, and then you would start to take on larger personal injury cases, those were all on contingency, of course, but where the recovery was less likely. But there was a certain baseline guarantee that you were going to have revenue. I mean, does that work here too? Is there any sort of, can you get to that level of certainty in the funding world, or is that would mean you'd be funding workers' comp cases in St. Louis, Missouri?
I mean, St. Louis, Missouri sounds excellent.
It's a great city.
I'll look it up if my US colleagues haven't already. It can happen, but I think, well, Leigh is one of the leading claimant firms, and they've only been taking on funding for the last 7 to 8 years. And again, just picking up on Nichola's comments, right? Maybe it's different in the personal injury space, where that type of I'm going to use the word churn because I can't think of a better one, but that you're talking about exists and has existed for a long time. But I think in the traditional law firm model, for which many in this room are going to be familiar, and in respect to which many of the funding applications are made, that churn model, where a track record of funding, a track record of these types of cases has only so much longevity, it certainly makes it harder to look at. I don't know whether Justin has a view.
Yeah, I think one of the things, we actually encountered this recently with a law firm that brought us a portfolio that they wanted funding against, and they were pointing to a precedent case that they had just had success in, but it was going up on appeal. And what they wanted to do is they wanted to carve that out. That was going to be, they had kind of done all the work, and they said, oh, well, and here, take these 5 very early stage cases. And we said, well, what we'd rather do and what would reflect better in the overall pricing of the deal is include your later stage case that's up on appeal. And yes, you put in the laboring oar and now set the precedent for these follow-on cases. But at the same time, it's going to impact how we look at it. And I think one of the things that I'm sure Rosie probably has these conversations, all the time is, okay, I'm being brought a portfolio of cases, and what else could there be? And there's a little bit more of a back and forth of how can we construct this portfolio in a way that really is beneficial for both of us, as opposed to there's a little bit of a traditional notion, and I think again this goes back probably 10 years or more, of saying, oh, well, I'm only bringing the cases to funding that I'm nervous about, and kind of changing the mindset on this is a tool that can be used more broadly and more regularly across a firm's portfolio.
And it's attractive for us because it gives us stability and it streamlines the process, and we may come onto it later, but negotiating individual funding agreements time and time again, or with very different terms, is really onerous. So you've got a portfolio funder, then you've got that security, you know exactly where you stand. Obviously, you've got to make sure you've got the right portfolio funder, because you're then thinking about liquidity and all your eggs are in that basket. And obviously it works both ways, as Rosie was saying, but it's, it is attractive. It's just finding the right funder and the right book of cases that makes it work.
What's a risk, a hidden risk in law firm financing that you think most people underestimate or miss. Why don't we start on the law firm side? Marc, you can speak about it from your perspective or frankly from the funder perspective, but what's something that people should be thinking about but they're not, and that's a trap for the unwary?
Well, first I must say that I am not aware of any portfolio or law firm funding in France. And so far, we only got funding on a case-by-case basis. And my experience, which might not be the experience of everyone, is mainly that most funders are not willing to do portfolio funding for a number of reasons. But I think that the market is now ripe for law firm funding and for more portfolio funding for several reasons. The first one is that the French funding market has become much more competitive, and the clients have become much more sophisticated. So you have a number of firms out there that have big damages to recover that used funding on several occasions, and they are not willing to pay what you normally pay on a case-by-case basis. So if there are solutions out there to pay less, they will use that, and law firms, I think, that will manage to offer them tariffs that are who manage to find funders who offer to their clients tariffs that are more attractive will be able to fund those cases. So I think the law firm funding as it is due to evolve very, very rapidly, at least in France and in a number of countries where there was no competition a few years ago, and there is much more competition today.
All right, well, let's hear it from the other side. What are some hidden risks, Justin, or things that people are missing in law firm funding and financing?
Boy, I think
Tell us your secrets.
Yeah, well, I definitely don't think there's any secret sauce overall, but I think the one risk that continues to just jump up and bite people is duration, and it's the thing that people are constantly trying to solve for. I think we try to incorporate in our deals the ability for some liquidity to the extent someone's running into kind of a fund life hurdle or something like that. But those types of delays, and I think are number one. I think number two is an effective and reasonable way to deal with cost and budget overruns. I think it's never a pleasant subject.
You sound like every client that I have.
Well, I think as a former lawyer myself, I definitely don't begrudge any firm their fees. I think that's definitely important, but it's there needs to be an equitable way to solve that. And I think that's something that is constantly I think a source of tension.
So, but how do you? So that was actually one of the questions: was how long do these cases take? Yeah. And the answer is often we don't know. So how do you deal with that, Rosie, with duration risk?
We take what the lawyers tell us and double it. No,
so it's like building a house.
I think that's an interesting standard.
So we need to have I'm being facetious, obviously, but to answer your previous question first, and just to build on what Justin said,
please.
I think the risk is greater than just duration and budget overrun. I think the underlying kind of point surrounding the 2 points Justin said was over-optimism. So I think that is the biggest risk. It's over-optimism on budgets and it's over-optimism on duration. But in a portfolio context, it's also over-optimism on win rates, and it's also over-optimism on damages. So I think really they're just the biggest risk is a view of the golden goose, and perhaps a little realism, I think, will help to diminish some of the biggest risks that I foresee in portfolio funding and law firm funding from a European perspective.
Nichola, any closing thoughts on hidden risks?
Well, I was just thinking, just to follow from what Rosie was saying, it's tricky, isn't it, certainly as a claimant lawyer, in terms of looking at the risks, the merits. looking at the value, because you're looking at it through the sphere of the claimant size, your counsel, everybody is on the same side. You're not looking at it critically in the same way that a funder is. And we do our best job of trying to be realistic and think about what those hidden risks are, what might come down the track. But of course, you can't predetermine everything. And there could be decisions and developments in other cases that then impact on merits, impact on value down the track. So it's difficult. I mean, we're very aware of it. As I said to you, it's a newish space for us. Of course, we've had a number of funded cases for a while, but it's still a new space, and it's constantly evolving. So for us, it's about learning, and obviously, people like Rosie and others, it's very helpful to have their assessment really as to what we need to be keeping in mind when we're thinking about applying for new funding products.
Justin, let's talk about correlation or concentration risk in a portfolio. How do you stress test for that or plan for that? Say, multiple cases exposed to the same regulatory risk or the same case law risk? Is it a question of just saying we're only going to take this number of ESG cases, we're only going to take this number of X, Y, or Z cases, or is there more sophistication that goes into it than that?
It's constantly a moving target across the portfolio. But I think when we're looking at it on an individual portfolio perspective, if a firm is coming to us with with a handful or more of cases, we're definitely breaking it down and kind of putting it together in a pie chart and trying to make sure that there isn't one slice of the pie where if you remove it, you're really at a risk of impairment. And so I think it's cutting up the data in so many different ways across jurisdiction, defendant, case type, in order to understand what those risks are and where you can sensitize not only losses, but then where things may come out in terms of damages, and also looking at defendant reputations for frankly how far they'll go in taking something, and we know from Leigh and Nichola here that often will go to the eve of trial or further. So it's trying to evaluate. It's really evaluating all those things and trying to put that into a numerical process where we can look at it objectively, as in try not to get too subjective and too in love with any particular one case or case type.
What sort of tools are you using for that? Are they proprietary? Are you just putting it in ChatGPT, Excel spreadsheet?
It's a lot of Excel spreadsheets. We're not big on. We're probably behind. We're using actually some AI, but I think there are just still sensitivities around confidentiality and how deep that use can get unless you're really building a proprietary tool.
I mean, it is hard too, because I run into this all the time in case budgets. Clients want deterministic certainty about litigation outcomes, but it's not deterministic, because to your point, you said we look at the reputation of the defendant, but you're really looking at the reputation of the defense firm, right? Or the plaintiff's firm. You're looking at, again, not to pick on Clark County, Nevada, but I spent a lot of time out there a while ago. You're considering, in the United States, are we in a jurisdiction where the judges are elected and they're basically elected by the plaintiff's bar, or are we someplace where they're selected? So it seems to me like, it sounds like a very difficult job underwriting the cost of that. But the flip side, this is where my insurance background comes in. This is what insurance companies do. And they're doing more and more of this. Somebody sent me an ad recently that they took a picture on the subway in New York. And the ad said, basically, law firms underwrite you all the time. We can do this for you as a claimant. So it certainly seems like, at least eventually, you'll probably be moving off of spreadsheets. Let's move to, go ahead, Marc.
Yeah, maybe I can add the perspective of law firms that bring cases to litigation funders. least what we're trying to do every time that we have a case is do our due diligence as thoroughly as possible to make sure that we anticipate all the risks as well. Normally, when we write a funding memo, for instance, we list all the pros and the cons that we can identify in the case, and then we discuss them with a funder. And I always find it extremely useful to speak with funders because they always play the advocate's devil and tell you, and can you make sure that this point is not going to be a real pain point? So I think that at the end of the day, it's in the interest of both the funders and the clients to anticipate all the risks as much as possible right from the start. No one wants to end up in a claim 3 years or 4 years down the line with problems that were not anticipated and that could have been anticipated because no one did this work properly.
The defense lawyers billing in 6-minute increments would beg to differ that no one wants to do that. We talked some about risk. I'm curious about return, and I know that there's some things that you can't tell us, but let me just ask this sort of generically. Maybe Rosie, I'll pick on you first. Do you think the best returns now are in single event bets, or is it in diversified portfolio plays?
They're not bets, just
Excuse me, investing isn't betting, yes. The best investments.
I think the best returns are from a diversified portfolio. Obviously in a single case investment, the returns are going to be higher because it's entirely a non-recourse investment and the risks are higher. But I don't think you can look at returns on are they better ostensibly from single cases? Yeah, sure they are. But if you have a diversified portfolio, so you're spreading the risk and then you're looking at a blended return, that's the best way to ensure the best returns for your investors ultimately at the end of the day.
Justin, what do you think?
I definitely agree with Rosie. I think that our view and I think Sarah and I have been working together the past 8 years, and I think have seen a lot over that time period, and I think that we much rather prefer that kind of steady upward trend as opposed to the volatility that comes along with the single case investments. I definitely understand that there are people that have the strategy where they prefer doing all single case investments or the bulk of single case investments and they're fine to weather that volatility. My view is that over time we're going to end up in the same place return wise and just eliminate some of the heartache along the way.
So you're looking for stable return over time as opposed to ringing the bell?
Yeah, I think that maybe this is as a background. By background, I'm a bankruptcy lawyer, so okay. I think as when an investment's going well, it doesn't take that much time to maintain and upkeep and stay in touch with everything. When something goes sideways, it takes 4 to 5 times as much time. So trying to eliminate as many things that are going to take 4 to 5 times the amount of time is really what we're aiming for.
Are there certain structuring tools, caps, hybrids, waterfalls, that make a difference in aligning law firm and funder incentives? Or other things that I haven't mentioned too? Rosie, you want to take that? How do you align incentives best, I guess might be a better way of asking it.
I mean, all of the things you've talked about, the one thing that we don't see as much in Europe and the UK as obviously is achievable in the US is the level of contingency fee. And being able to, on a single case, where the contingency fee is as significant as you often see in the US.
Up to 40% usually, that's the max.
Yeah, but that's the uptake you can take, but the lawyers work on 100% contingency. You don't get paid at all.
Yeah.
It's very, very rare to see that. It happens, but it's unusual to see that in a funded case in the UK and Europe, in my experience. Others may have other experiences, obviously. But so on a single case, that along with everything you've talked about, caps, waterfalls, budgets, etc., requirements in the LFA. And then on a portfolio basis, you've got so many more tools protect yourself from alignment perspective. In certain European jurisdictions, you can have step-in rights to run the claims and things like that. So then you're starting to look at it as a normal structured finance deal, to be honest, rather than as a single case transaction.
How do you, there are some of the more successful plaintiffs firms in the United States, I think are skeptical of funding. Their view is we can just fund it ourselves. We have the money, we've got our own dry powder, why should we share? I mean, what's a compelling argument, Justin, to those firms?
I mean,
you probably know who I'm thinking of.
I mean, yeah, there are several, but I think the counter to that and is a company like Apple. They don't need to take out bond debt to build a new headquarters or to, open a new factory, yet they do. And so if some of the largest companies in the world are tapping the markets and raising financing because that capital is cheaper than their equity capital and they have better uses for it, I don't see why firms wouldn't approach it the same way. I think a lot of the different structures that funders bring to the table and the collaboration with law firms is helping modernize law firms and I think help them run more smoothly over time so that they can grow at attractive rates.
So what was compelling to your firm, Nichola, about taking law firm funding? You said you were new to it.
I think on a very basic level, it helps partners sleep better at night. That's definitely a factor. But it's about opportunity. So thinking about things that we could do as a business that we couldn't have continued to do if we're just self-funding. The firm's grown hugely in size over the last 10 years, but primarily over the last 3 or 4 years. And we now do an awful lot more than we would have done in the past had we not had the ability to have shared risk. So for sure, it's opportunities, and also it brings on board other skills. And you were just speaking about them earlier, but it brings on board other opportunities with investors who can look at cases with you forensically. You're really putting your case under a magnifying glass, which it actually is beneficial. It's beneficial for you as a law firm, but also for the claimants. So really focusing in on the strengths and weaknesses of the case. So it brings those opportunities as well. But certainly at the moment for us, as I say, the book of group claims at the moment that we're bringing, 50% are funded. The others are smaller cases, either might not attract funding or maybe for a particular reason it wouldn't be in the right interest of the claimants to have funding in that case.
I have a long list of additional questions, but I see I've got about 2 minutes left here. I do want to open it up to the audience if you have questions. I know some of you have questions. Don't be shy. Nobody? Are we just getting in the way of lunch? Is that the issue? All right, here, I'm just going to ask you one off the cuff.
There's one at the back.
Oh, there's one in the back. Go ahead.
Right at the back.
Thank you very much. Well, that's loud. I just wondered about portfolio diversification and secondary market. Is there a secondary market yet developed in litigation funding, and is that part of portfolio diversification, considering bringing new cases and releasing other cases, and how much has that grown over the past few years?
David, I'm happy to answer that, because there's a whole session after lunch, so we don't need to answer it. You'll just need to stay.
Are they going to talk about tokens too? Because I see digital asset tokens for secondary trading of claims. Anyone else? So a couple of questions that I want to ask. Let me pick the trickiest ones. What's the most toxic thing right now for funders, I would say? What's something, 15, 20 seconds? Can you say?
Difficult questions from David Green.
What's that? The kind of litigation that you think is a bad idea that you see other people do.
Gossip, that's the most toxic thing.
Gossip, there you go. Justin?
Well, I think just industry-wide, the industry itself not taking a stance on some of these regulatory issues. And I mean
Which
industry. I mean industry both in terms of funders and law firms that are taking things on risk. And so a lot of people have been sitting back and letting these developments come to them and then respond. I think that we all need to be proactive in that regard, so that I don't think we're not against regulation. It's so long as it's done the right way. And but I think we need to have a voice in that. And I think that right now a lot of the stuff that's going on, at least I'm definitely more focused on the U.S. But in the U.S. it was going on without funder input. In the UK, I mean, we can talk about the CJC report. I think some of that is also, in my view, there are recommendations there that are very anti-funder, so or skewed against. And so I think we just need to make sure we're at the forefront of that.
All right, well, I see 0 on my clock, and I know that there is, we got a little bit off on our schedule, and I know there's lunch waiting out there and time to chat and mingle. Thank you to the panelists, and thanks to all of you.